Do special funds actually preserve your capital, and are there hidden truths about special funds? I don't know about you, but I often find myself worrying about money that I have actually invested in a safe fund. And I know this is very common, and maybe please type yes if you have ever worried about money that you have invested in a fund that you believe that is safe, but you actually worried about it. Yes, and today I want us to speak about the safety in special funds, for example, in Mansa X and also in Oak Special Fund. And we have been speaking about special funds for a while now, and people are worried about the capital preservation aspect of special funds, because when you speak to some people, they say that special funds do not preserve your capital, while others, they say that special funds, they preserve your capital. And today I would like us to address this so that we understand our investments. Okay, so I always advise people or investors to call fund managers or fund owners before you invest, so that you can maybe clarify some of these things. And I give information here so that you know what to seek clarification on. If you have never heard of a fund, then it is hard for you to even know what to ask. And that is the reason why I do these videos, to make sure that you know even what to ask when you go to these fund managers. During my research, before I do these videos, and if at all I have not invested in a particular fund, I make sure I call the fund owners as well, to just assess a few things, like customer service, to assess a few things and get the correct information from the fund managers. So I have spoken to people in Mansa X, and I've also spoken to people in Oak Special Fund, the customer service in Oak Special Fund and also in Mansa X. When I called them both, they said that they indeed offer capital preservation. But here is how it works, because capital preservation in special funds is not the same as capital preservation in money market funds. And I think this is where there is a bit of conflict of information and a bit of misinformation here and there. And I want to clarify this. So money market funds, they guarantee capital preservation. But for special funds, they aim to preserve your capital through diversification. Okay? So money market funds, they guarantee capital preservation. But for special funds, they aim to preserve your capital through diversification. This is what makes money market funds safer than special funds, because ideally the underlying assets of special funds, they are risky assets. Unlike the underlying asset of money market funds, they are safe assets. Yes. For special funds, the underlying assets are risky investments, or they are risky assets, but because of the diversification, they're able to preserve your capital. And we are going to go into details on this, and I'll give an example for this. For Mansa X, according to this, you can see that the risk profile is 2, and for money market funds, the risk profile of money market funds is 1. It's a low risk investment. In the spectrum of investment, money market funds are considered a 1, and for Mansa X, it is considered a 2. But if you go into fine details of the investment that they have actually invested in, these are high risk investment. All right, what does this even mean? So special funds, they employ multi-asset investment strategy, and also they do leverage trading, and they invest both in local markets and also in global market. Again, let me give an example of Mansa X. When all the investors contribute money, here is where they invest your money. And I want you to look closely at this diagram or this table. You see where the money is invested in. This is where they invest your money. This is the top 10 holdings, and I know I got a question which I'm going to discuss later on this video, and I'm very happy that you guys, you're very keen. There is someone who came after I shared this last time in a previous video. There is someone who added these percentages, and they found out that it is not 100%. So for the remaining one, because this is the top 10 holdings, they have not indicated where how much they invest towards leverage trading and how much they put in active trading, as we are going to discuss later in the video. But I like that about you guys, that you're keen enough to check the numbers, you're keen enough to look at the information that I'm also giving, so that you you make sure that it is the correct information. Thumbs up for that. And now let's continue our discussion. Today's session is very practical because I will be giving examples so that we make sure that we understand this. Now, from this diagram, let's say for example the Nasdaq 100 didn't perform well at maybe last quarter. Yes, let's even take a worst case scenario. We imagine that Nasdaq 100 was completely wiped out, that the whole investment was wiped out. Yes, what that means is the fund would lose 4.20% of the total assets under management, which as at March 2025 stood at 47.29 billion Kenya shillings. That would translate to a loss of about 1.986 billion Kenya shillings. If we lost the whole amount in Nasdaq 100, we would have lost in this particular fund, that is Mansa X, would have lost 1.986 billion of the money invested by the investors. Now remember, this amount is not invested by a single person. So if an individual had invested, let's say 250,000 Kenya shillings, that 4.20% loss would amount to roughly 10,500 Kenya shillings. That is what you would lose as from the capital that you have invested. But here is the important part where diversification comes in. So even if the Nasdaq 100 was wiped out, the fund would still preserve your capital as long as the other investment performs better than the Nasdaq 100. And in this case, the other asset would only need to generate a return of 4.2% to cover the losses and break even and preserve your capital. That is what they would need to preserve your capital, only 4.2%. I hope you are still together so far, yes? So if you look at the fund composition closely, you'll notice that the largest portion is allocated to fixed income instruments. What does this tell you? It tells you that the largest percentage is in a generally low risk investment, meaning that for you to lose money in this investment, there would have to be a major blow even to these fixed income instruments. This makes it highly unlikely that the fund would lose your entire investment. Yes, and this is basically the reason why special funds are able to offer good returns, because all they need is for a few of these funds that they have invested in, or a few of these assets that they have invested in, to just perform well, and they cover for the rest that have not done well. Now, I think the real question here is, Susan, can you actually lose money in a special fund? And the answer is yes, you can actually lose money in a special fund under very extreme circumstances, and I want us to discuss those circumstances so that we know and understand where we are keeping our money. Let's now talk about some of these scenarios, and before we proceed, kindly take a second to like and share this video. It will help a lot in pushing this video to people who need it, or people who have already invested in these funds and they don't know the risk, and they don't know, or they may want to invest in this fund but they are scared to understand how it works and how what are the risks of investing in this particular fund. Yes, our scenario number one is a global crisis or maybe a global shock, and this is actually one of the questions that I received when I posted our previous video on special fund. So here is the short answer to what would happen if we had a global crisis. Special funds invest heavily in global markets, and in case of a global crisis, it would affect the returns on these particular funds. The diversification does help to maybe cushion the losses, but in extreme cases, global events can shake the most balanced portfolio. And I want you to think about situations like maybe a global recession, maybe a pandemic like the one that we had, COVID-19, a war in a major economy, or maybe a sudden stock market crash. Another example of how tariffs would affect this kind of fund is if the fund was exposed to maybe a tech company that rely on, for example, Chinese manufacturing or maybe exports. Those companies might have taken a hit from the tariffs, yes, and this would reduce the performance of that particular fund or the fund in question. But this again is subject to diversification, and it would only go wrong if they didn't follow what they have in their fund fact sheet in terms of the percentage that they're supposed to allocate in a certain company. If they didn't follow that, or maybe they put so much money in a certain asset and that was not supposed to be the case, or maybe they became greedy and they put money where it was not supposed to be put, that would mean that they would make major losses. But if they went as per capital allocation, or as capital allocation towards that particular company or towards the trading, it would mean the diversification would help them from that kind of losses, yes. So in case of global crisis, it would mean that this would affect the returns. It would also affect the fund as well, because a global crisis would affect everything in the markets, yes. And I would like to emphasize, during such times of global economic crisis, almost all markets can drop sharply, yes. All markets will be affected, and even the safer assets may not perform well enough to maybe protect your capital. And again, from the diversification in times of global economic crisis, if multiple assets or multiple sectors underperform at the same time, the fund may record a negative return, and that would affect your investments or your capital. That way you would lose your money in a special fund. Yes. Number 2 scenario of how you can lose money in a special fund is bad trading decision, which I think we have talked about a little bit in our point number 1, but in short, special funds usually do something called active trading, and they buy and sell assets depending on where they believe opportunities exist. They can bet the prices will go up, or they can bet the prices will go down. But there is one thing that is true in all trading or in active trading: there is no one trader that gets it right 100% of the time. Okay, so what does this mean? This means that if a few major trades go the wrong way, especially in volatile markets, it would lead to major losses. The fund managers I know are professionals, but they're still human, yes, which is where experience comes in to make sure that they reduce the number of times they are wrong when it comes to active trading. And again, diversification also helps a lot in this, because active trading doesn't take a large percentage of the investor's money, and this is the reason why I said in our previous video, in case something happened to a fund manager, it is very hard to transfer this the fund or the investment to a different fund managers, because not everyone can do this. Not everyone can make profit in leverage trading and also in active trading. Not everyone can do this, so this requires professionals and people who know what they are doing. I know they have not indicated how much they put in active trading and leverage trading, but from this fund fact sheet you can see that these are the top 10 investment assets, meaning that the remaining 50 something percent may go to active and leverage trading and also other assets that they have not indicated here, but they say that these are their top 10, meaning that the rest, they take less than the percentage that you are seeing here. So this takes us to number 3 scenario of how you can lose your money, which is leverage risk, which is very close to our number 2, and this one is a bit technical but very important. Yes, so the special funds that currently we have, that is the Mansa X and the Oak Special Fund, they use leverage trading. It's not always the case to all special funds. Some special funds may have a different strategy. Not all special funds should use leverage trading, but the ones that we have, they use leverage trading, which simply means they borrow money to increase the size of the funds that they trade, or they borrow money to increase the size of their trades. Yes, their goal is to boost returns, but the flip side is the losses are also magnified. And let me break it down with a very simple example. Imagine you fund your trading account. For example, you do forex trading and you trade your account with 5,000 Kenya shillings. But the platform allows you to trade as if you had, let's say, 50,000 Kenya shillings. That means you're using borrowed capital. Your actual capital is just a smaller portion of the full trade size, yes? The advantage of this is that you can take larger position and possibly manage market volatility better, because bigger trades allow more flexibility in strategy, or allows you to take even bigger risk, yes? But also it means that even small losses in the market can eat into your real capital very quickly, yes? Now, imagine that concept applied in a much larger scale, because now we are not talking about 5,000 Kenya shillings, we are talking about much higher amounts. And that is basically how special funds do leverage trading, or use leverage trading to make you bigger profits and take bigger position across the different asset classes. You know, it can lead to impressive returns when trades go well. It can also lead to amplified losses when things go wrong. So if a trade works out, the gains are impressive, but if it doesn't, the fund can lose more than it would have using just the normal capital or their own capital. And in very extreme cases, this can hit the value of the fund hired. And again, we go back to diversification. How much have they allocated to leverage trading? So that we understand how much loss are we talking about. How much they are going to lose is dependent on how much they have set aside or they have allocated in leverage trading. Okay, continue. If you want me to break down more funds like this, type more please in the comment section so that I know, and I will be bringing you more information about different special funds and different investments so that you can assess our options. At the end of the day, we need to diversify our investment, and we cannot do that if we don't have options. So make sure that you type more please in the comment section, like the video, and also subscribe for more insights. Yes. Number 4 scenario of how you can lose money in a special fund is through regulatory and system risk. Yes, these are the rarest, but they do happen. Yes, and they are out of the control of an investor. It's out of control of you as an investor. And then an example is maybe there is a change in regulations that affects how the fund operates. And number 2, a system failure or maybe a cyber attack on the trading platform. And number 3, they can have an issue with the custodian bank. Custodian is basically where the fund's money is held, yes? While such issues are rare, they can still affect your access to the funds or the value of your investment temporarily, or maybe a permanent loss in extreme cases. And the temporary case I'm talking about is, and I know that maybe you have seen this before, where there is a system maintenance in a company, or maybe there is something that is going on with the system, a system failure, and within a certain period of time you're not able to access your money. And in such scenarios, there might be a very big panic from the investors, because they are not able to access their money. And most of the time in such scenarios, that's when we see a lot of people withdrawing their money from such investments. And in such a case as well, you're going to maybe feel, even if you have not withdrawn your money from that investment, you can feel the impact when a lot of people are withdrawing money from a certain investment, because in their structure, that is not how they're supposed to operate. This is not a liquid investment. So once people are trying to withdraw a lot of money from such an investment, you as an investor, you would feel the impact of it, because it would mean even their investment strategy would change. And I will add to this, I know that we have discussed about what would happen if a fund manager went out of business in a special fund, but unlike in money market funds, in special funds, if a fund manager went out of business, it would mean that this fund would be liquidated, or the assets would be liquidated. And liquidation in such an asset would mean that you have to time the market right. But at this particular time, because the fund manager is out of business, there is no time to wait for the markets to be at its optimal. No time to wait for the right prices in the market. A liquidation would mean that selling those assets at the price they are at that particular time, and that would mean that you may make some losses and you may lose your capital. Okay, so at the end of the day, yes, special funds do aim to preserve your capital, but they do this through diversification, and it's not guaranteed. That is why they are more suitable for long-term investors, ideally 2 years plus. Yes, they're also suitable for people who understand that risk and reward go hand in hand, and higher risk means, or higher reward means high risk, and definitely not for money you will need urgently, like rent, emergencies, and such kind of things. Then only invest what you can afford to lose, and only 10 to 20% of your investment should go in a single investment. To help you with this, I have a question that you can ask yourself so that you make sure that whatever you're putting in such a fund is not too much. I want you to ask yourself, what am I comfortable to risk in such investments, and what would happen to me if I lost everything that I've invested in this fund, or I am planning to invest in this fund? If the answer scares you, it's time for you to reevaluate your investment decision and look for places to diversify your investment, and also make sure that you have an emergency fund set up somewhere, so that in such scenarios where maybe there is a system failure or maybe a cyber attack or something like that, you'll have somewhere else to get your money. Okay, and if you want a one-on-one session about investment education, make sure that you're using this number, and I charge a small fee, and I promise it's a very small fee, something that you can comfortably afford. Yes, and you can consider watching this detailed review or special fund we have here in Kenya. And thank you so much for watching and for the support. Happy investing, and see you in our next video. Bye.